Hi guys, welcome to our webinar. We'll just wait for others to join. I'm not sure how long that will take, but experience suggests a couple of minutes. So I'm JB, I'm the founder and CEO of Squirrel, and with me today is Dave Tyrer, who runs our peer-to-peer platform. Squirrel's been going 11 years now, basically since the GFC. We launched right in the peak of the GFC. Initially as a mortgage broker. As a mortgage broker, Squirrel does about $1 billion, maybe a little over $1 billion of mortgages a year. So we're a pretty substantial mortgage broker up here in Auckland, but we do cover the whole country now. In the last 3 or 4 years, we launched our peer-to-peer platform, which allows us to fund lending products. We started that with consumer finance, and more recently we launched some mortgage products onto that platform, which of course we understand really well. So this is really an opportunity to introduce mortgages to investors, why we think they're a great investment in a world of very low yields. So look, I think we'll get stuck into it. So what you can expect from today. So we want to help you feel more informed about the risk profile of investing in loans that are secured over residential property. We're going to give you a bit of a framework so that you can learn how to assess that risk and better understand it. Now that sort of framework you can apply to our platform, but you can apply it to other lenders out there that are in the mortgage space. Whether it be residential mortgages all the way through to commercial property development. To be honest, any form of lending that you're looking to invest in, or into companies that do mortgages, like finance companies and that sort of stuff. Dave will give us an update on our personal loan book, which has been running on the platform for a good 4 years now. Given COVID and given the impending recession, it's good to go through our performance on that book, just so that you understand how our platform works, how we manage the risk, and as a result of that, what we kind of expect the outcomes to be. The presentation is going to take about half an hour, and that will leave us plenty of times for Q&A. And the presentations we've done so far have had really good Q&A sessions. So we'll get onto that then. Disclaimers. Today's presentation isn't investment advice, and we'd always recommend that you seek advice before investing. The main point that we do like to make is it's important for any investor to diversify your risk and invest across a number of different asset classes in terms of property, shares, bonds, peer-to-peer investments, but also across platforms, so that you don't have too much risk with any one of your investments. So where I want to start is on qualifying credit risk. So this is really giving you guys a bit of a starting framework. So what we know is that a credit loss, or for you to lose money when lending to people, there's going to be 2 elements to that. There's going to be a probability of default, and there's going to be a loss given default. The probability of default's kind of pretty obvious, right? It's the probability that your borrower isn't going to be able to repay their loan. And look, in the consumer space, the biggest risk there is unemployment risk. So if a borrower loses their form of income, they won't be able to service the mortgage, and eventually they'll default on the loan. So that one's kind of obvious. The other risk that we see in that space is self-employed people, particularly self-employed people that have been self-employed for less than 5 years. Because there's a much higher probability that they'll get themselves into financial trouble. Another aspect that we might see with probability of default is someone that's got bad behavior historically, credit defaults, that sort of thing, which would indicate someone that's not particularly good at managing their money. So that's your probability of default. The other factor that we need to think about is the loss given default. So what's loss given default? Well, If we were lending out on a personal loan and it's unsecured and the borrower defaults, then our ability to collect that loan is going to be pretty remote. So you could say the loss given default would be 100%. The benefit we've got with residential property is we've got an underlying security there, being the house. So the loss given default is the borrower defaults on the loan. We eventually force a sale on the property. Hopefully they sell it before that, but we eventually force a sale on the property. It sells for an amount less than the loan. So the amount we get repaid is less than we lent out, and therefore we have a residual loss. The lower the loan to value ratio, obviously the lower the risk that eventually could occur. So if we take this scenario and just work through the loss given default a little bit more, because it's important. If we, in this example here, we have a house that's worth 500,000. We have a mortgage of 400,000. So that's a loan to value ratio of 80%. So the mortgage is 80% of the value of the property. We call that an LVR. You'll hear LVRs mentioned from time to time. The Reserve Bank talks about them a fair bit in terms of de-risking the banking sector. They like to see lending below 80% LVR. So this loan's at 80%. Now, if house prices fell 15% and we sold the property for 425,000, the mortgage is still 400,000, but we've got 40,000 of costs that have accumulated between when they started to default and when it's sold. Now, those costs will include penalty interest, they'll include real estate fees, and they'll include legal costs. So there's an accumulation of costs that have occurred there that we've also got to deduct. So that leaves us with a loss of $15,000. And so our loss ratio is 3.75%. Or we've lost 3.75% of the money that we lent out. So what we see here is, next thing, we need to establish a probability of default. Now, a normal probability of default would be less than 1%. I'm using 5% here, and we'll come back to that number later on. Needless to say, that's a conservative number. That's saying that 1 in every 20 borrowers defaults on their loan. We simply don't see numbers that bad, but let's assume that for the sake of this example. Probability of default 5%. The loss given default in our example where the price fell by 15% was 3.75. That says on a portfolio of loans, your expected credit loss is going to be 20 basis points or 0.2 of 1%. So with our home loan product on our platform, we are receiving, or investors are receiving, a return of 4%. So back off the expected credit loss of 20 basis points, and you get a net return of 3.8%. So what you can sort of see there is a reasonably high probability of default and even a reasonably significant reduction in the property price, plus allowing for additional costs on an 80% LVR loan, hasn't had much impact on the expected return at all across a portfolio of loans. So what does the world tell us about loss rates on mortgages? I mean, that sounds kind of cool, but how realistic is it, and what evidence is there out there to support it? So what this graph's doing is looking at Australia during the GFC. This is from the Reserve Bank of Australia in one of their reports. And it's looking at loss rates. And so what you sort of see on the left-hand side of the graph is lending effectively on purpose, lending to business versus lending to households. You see that a lot of the credit losses are related to business, and that shouldn't be surprising given that business is high risk during a recession environment. On the right-hand side, you see the same thing again, but split by product. And the difference here is that the consumer finance products sort of jump up the graph to be similar to business because there's not a lot of security there. Home loans is very, very low. In fact, it's hovering around 5 basis points or 5/100ths of 1%. Very, very low number. And that's actual losses. If we sort of look a bit further afield and we look at Europe and the US, sort of over the same period, but even going back further to 1991, 1992, you see the loss rates there. So the first one to look at would be the UK market, 2008, 2012, so that was the GFC. Cumulative loss rates on their housing book were 0.5%. Sweden, 1991, 1993, so that's after the 87 share market crash. That was New Zealand's worst modern day recession. We had unemployment in New Zealand reach 11%. We didn't have as good data as everyone else, so I can't report our loss rates, but Sweden had loss rates of around 1.5%, so still relatively low. The UK during the same period might have been as high as 3%. The losses were spread between mortgage insurers and the banks themselves, so a little under 3% there. Ireland, which I'll come back to again shortly, 2011, 2013, so this is the GFC. Ireland experienced, if we ignore the US, because the way the US works is completely different to our market and to any comparable markets, but Ireland does look a bit more like us. Ireland had a loss rate of 5% cumulative over that period. But to put that in context, Ireland had probably one of the biggest modern day meltdowns in world history. They had a 14% unemployment rate and a 50% reduction in house prices. House prices halved. And there were a lot of reasons for that, which I think I go into in a further slide. Oh, the next slide, actually. So let's think about an Ireland scenario. Now, what I want to do here is I'm going to paint it slightly different because we've got to put a New Zealand context on it. So we're going to use a probability of default of 10%, similar to Ireland, which says that the default rate in a worst case scenario kind of equates to the unemployment rate. That would put us up maybe somewhere near 10%, worst case scenario. Loss given default, on our platform, we lend out at 80% LVR, so there's already a 20% buffer here. So loss given default of 30% is actually as a 50% reduction in house prices and or costs against the mortgage. So what you see there is that that's giving us a 3% loss rate in a kind of worst case scenario. And we're paying investors 4%, so there's still an expected positive return. And in this scenario, capital would be protected. Now, the interesting thing with Ireland to point out, because it really is a worst case scenario, is that in Ireland, over 50% of new lending leading up to the GFC was over 80% LVR. So it was a market that was very heavily reliant on low deposit lending. Conversely, in New Zealand, we've had LVR restrictions from our Reserve Bank for a number of years now, as the market's prices have been going up. So our over 80% lending has been around 10%, far less. So far less risk in our housing book relative to Ireland. The next point with Ireland is it was going through a massive construction boom, and what drove prices down was a significant oversupply of houses. You've got to remember back to the GFC as being a financial crisis, and it was a financial crisis that was born out of cheap and easy money. And that's not the environment that we're in at the moment. We're in a health crisis that's leading to an economic recession. We're not in a financial crisis, albeit, people have been able to borrow money. It hasn't been all that easy. We've had LVR restrictions in place for some time. Developers have struggled to get money out of banks and have had to go to alternate funders that have been expensive. There isn't an oversupply of housing in the market. So all of these things sort of make New Zealand quite different to Ireland. But it's a useful case to demonstrate how capital is protected with residential mortgages, because even with relatively high or very high probability of default and very high loss given default, your expected credit losses on a portfolio of loans is still less than the gross return that we're able to generate from those loans. So if we look at the sort of relative credit risk of lending against mortgages, this is important because we're introducing different product classes onto our platform. It's also important because as an investor, you've got different options in terms of where you put your money. And when you look at that, you need to assess that relative to the risk, not the absolute return. There's always a risk-return trade-off. If you're going to take more risk, you expect a higher return. If you're going to take lower risk, you'd expect a lower return. And you've just got to decide where you want to be on that equilibrium. Just don't be too simplistic with that and just look at the rates. You know, that was a mistake that a lot of people made during the GFC when they piled money into finance companies. And it didn't turn out too well because they were doing high-risk lending on high-rise property development. So what we have on here is our risk spectrum. This tends to be how we grade risk. At the one end of the spectrum, you've got high-rise property development. The risk of that type of investment is that if the borrower defaults, the loss given default can be very high, and the borrower has a reasonably high probability of default. That stuff can get really messy. We've seen that before. We saw that during the GFC. High risk, high return. You move down the scale through smaller scale property development, through to personal loans. Personal loans are lower risk. That's not intuitive for a lot of people. People assume that the risk on personal loans is a lot higher than it is. The reality is in New Zealand, it's hard to walk away from your debts unless you lose your job. So across a portfolio of loans, where you've got a large number of these loans, the risk across the portfolio diminishes significantly. And on our platform, the personal loan loss rate is only about 1.5%. Build loans, residential build loans. This is a market that we're in, so I'll touch on that a little bit more. This is single house builds, generally turnkeys, where we're funding the builder, and there's an end buyer that's purchasing the property and is already unconditional. So we see that as being relatively low risk. We've got an end buyer who's unconditional, paid a deposit, so they've got skin in the game. We've got a group builder who has a reasonably simple cost base and good management and processes. So we see it as relatively low risk, plus we've got the benefit of residential security. Down to home loans, which was shown between a risk level of 2 and 3. The reality is once we build up a decent sized portfolio of home loans, the risk, because it gets diversified, the risk is very low. And it's a very solid investment as the previous examples demonstrated, but it does rely on diversification and it does rely on a portfolio. So what we recognize here is that we're probably a 3 in the short term because the loan book is small and it's just gradually building up. But as that book gets built up, we expect the risk profile to diminish even further. I'll hand over to Dave for this part.
Good one. Hi, everyone. So I'm going to talk a bit about how a reserve fund can help get some diversification in place for peer-to-peer investors. The diagram that you can see on the slide there shows how a reserve fund works. This is just an example, and I'll keep the numbers simple just for explanation purposes. This all kicks off with our investors funding a loan to begin with. The next step is that a borrower starts making repayments. When the borrower is keeping up with their payments, each one gets carved into 3 pieces. So a small amount heads over to the reserve fund, a small amount goes to Squirrel as our margin, and the bulk of that repayment goes off to our investor. In the event that the borrower doesn't make their payment, then the reserve fund steps in and makes that repayment to the investor. So the investor can expect their repayment as normal, assuming the reserve fund has money. Let's assume the borrower makes up the payment they missed either the next day or sometime over the next couple of months. The extra amounts that they repay are then paid back to the reserve fund until things are squared away. Because all the investments are making a contribution to the reserve fund, all investors get the support of that reserve fund if a loan they've invested in goes into arrears or into default. JB talked about the importance of diversifying. And so the role of the reserve fund is to help support that diversification for an individual investor who's invested into an individual loan. If their particular loan goes bad or goes into arrears or default in some way, shape or form, then the reserve fund covers them, which everyone has contributed to. So JB, do you want to move on?
Yeah.
So now I'll talk just briefly about the two new investment classes that we introduced in March, just ahead of our level 4 lockdown, which was great timing for us. So our home loan and business property loan investment classes focus exclusively on residential property. It's an area we know well, having with us writing over $1 billion a year in mortgages. You can see some information on the page there, all of which you'll see replicated in our investor handbook, which you can find on our website, along with a description of all of the different types of potential risks. The home loan investment class is likely to be better suited to people looking to protect their capital and generate a regular income payment. The loans are first mortgages with LVR less than 80%. Typically, the loans are for good quality borrowers who have not been treated fairly by big bank credit policy. So this investment class is returning 4% per annum, and the interest rate on that is variable. So as interest rates in the market go up and down, we'd expect that rate will go up and down. Business property loan investment class is likely to support people comfortable with a higher degree of risk, with regular income being important. These loans are first mortgages and typically for construction of residential house and sometimes a small number of small residential homes. Maximum loan size ensures the scale remains small. So maximum loan size you can see there is 2 million or $1 million per security. Often the loans are turnkey, which means that there's a confirmed buyer already in place on the completion of that house. This investment class is returning 5% per annum. Once again, the rate is variable and the rate will move as the market moves. Probably important just to point out the term across the two products. So the home loan term can be up to 7 years. While we don't expect all loans to go to 7 years, investors will need to go in to that term on the understanding that the loan that they could be allocated could be up to 7 years long. Business property loans term is up to 2 years. What we're finding is that the bulk of loans in that space are typically about 9 months on average. With our product, there also is the benefit of a secondary market. So a secondary market allows you, if you've made an investment, all of a sudden you need to get your money back for whatever reason, then you can make that investment available for another investor to pick up. So there is a secondary market in place, and there's a small fee attached to trading out in those situations. However, key thing is you can look to trade out that investment, provided there's another willing investor on the other side of it. Thanks, JB. So the last part that we'll talk about today is the Squirrel Personal Loan portfolio performance. This personal loan portfolio's been around for almost 5 years now. There are around about 1,000 active investors, and on average, they've invested about $17,000 in the portfolio. We're nearing about $45 million worth of loans that have been written over time. 30 million of those have been repaid, leaving an active loan balance of about $15 million. The diagram or the graph you can see on the page here is the reserve fund in action. So I think we've put this on here so you can get a really good feel for how the reserve fund would work with a major credit event sitting in front of us. So the blue line that you can see there demonstrates that reserve fund building over time as contributions are made to it from each loan. The orange line is us starting to play around with some different scenarios of what may happen over the next, let's say, 12 to 18 months. And the picture that we've shown is out till March next year. So on assuming that an unemployment rate gets to about 10 or 11%, and assuming that we have to get to the point where a whole lot of loans default, then we'd see that reserve fund drop from a balance of about 500,000, potentially as low as 200,000. And we've taken a pretty conservative stance and been quite aggressive with some of our assumptions. And so far, we're not following that line. We're doing better than that line. However, there's a lot more of this economic environment to come. A couple of other points there. With our portfolio, about 2/3 of the loans that we have are secured in some way, shape or form. So the ability to collect on them obviously is stronger should those loans go into default. And where a collection is made, then that money is sent back into the reserve fund. If we look at the borrowers that we have in the personal loan portfolio, at the end of April, we had 39 loans that were in a hardship situation. So that's where the customer has moved to a repayment holiday, or they have moved to interest-only terms. The loan arrears in the portfolio at the end of April was at 3.2. Today, that rate's at about 3.5, and the number bounces around about that level during the course of the month. So that gives you an overview of the personal loan portfolio, and look forward to some Q&A on that in due course. So just to summarize, before we get into the Q&A, three things that we've talked through today. So first of all, JB talked about credit risk and what that means for investing in loans and residential property. I talked a bit about our home loan and business property loan product, investment classes that we have available. And last we talked a bit about the performance of the Squirrel Personal Loan portfolio. So now we're going to move over to Q&A. So feel free to start jotting some questions down. You'll find the Q&A panel at the bottom of your Zoom screen. So we'll give people a moment just to get them started there.
So Dave, maybe a quick question for you.
Sure.
You were talking about the secondary market. What's been the experience of the secondary market over the last couple of months with COVID-19?
Sure. So we've seen a very active secondary market. So between late February and the end of March, we saw about $1 million of investments move through that secondary market. We saw a range of investors saying, hey, I see better opportunities perhaps in the equity markets to place my investments and trade it out. Equally, we saw a range of investors either register or put more money into the platform. And having spoken to a few of them, they have said, well, the reserve fund is in place. It looks like it's performed well. And they're saying, well, yes, I can get a pretty reasonable return here. And that reserve fund actually helps protect against the risks of loan arrears and defaults, which isn't available in other parts of the market. So yeah, it's quite an active secondary market during that period.
And we've managed to clear the whole thing out.
Yeah, we have, yep. So all of the investors that have chosen to use the secondary market have found willing investors on the other side.
Yeah, which is great. Just a quick little question from Mark. Where do we find the handbook and the legal documents?
Sure. Easiest way for me to describe on our website, if you scroll right to the very bottom, you'll see legal documents in the black section at the bottom of the page. In there, if you go into the legal documents tab, then you'll find our investor handbook and all of our investor agreements.
Yeah, is the investor tab also on the main investment page?
Yeah, so I think on all parts of our website that you go to, if you scroll right to the bottom, in the black section, you'll see a little menu there called legal documents, and that's where you'll find it.
Yeah.
It's also in the invest section of the website.
Okay, thanks, Dave. Cool. I'll answer this next one from Nick. Are we investing in a fund or individual loans? Because it's an interesting question. You're investing directly, because it's a peer-to-peer platform, you're investing directly into an individual loan. So the repayment characteristics of that loan will reflect how your cash flow comes back to you. So if you invested into a loan and then that loan repaid, you would receive your money back into your call account. So there is a direct relationship between the loan and your investment. The difference is, because we have a reserve fund and we have a socialization clause, which you sign up to as an investor, it behaves a bit more like a pooled investment scheme, with the reserve fund providing credit protection to the entire portfolio. So all investors jointly own that reserve fund through the trustee. The reserve fund accumulates funds, obviously covers credit losses and arrears, which means that investor payments are kept up to date. If your loan defaults, the loan that you've invested in, it's paid out of the reserve fund, hence the losses socialized across the platform. So it's a bit of a combination of both. From a cash flow perspective, you're investing directly into a loan, but from a credit risk perspective, the risk is socialized across all investors in the platform. So hopefully that makes sense. Dave, are you finding that bank second-tier lenders are quite nervous with new lending at the moment?
I think it would be fair to say any company involved in the finance industry will be looking really hard at any new applications for credit coming in some way, shape or form. I think a couple of interesting observations, if you look back at the global financial crisis and the finance companies through that period, one of their biggest challenges was a liquidity challenge. So often a finance company will write loans that, let's say, have a 5-year duration, but a lot of their investors are placing debentures for, let's say, 12 months. So they're writing this loan over this term, and they've actually only got funding for a shorter term in some situations for that. So if investors start becoming nervous and they don't renew those debentures, they start running into liquidity problems. So we have seen a number of finance companies just being really cautious with any lending that they're doing. Banks have got really big balance sheets. They want to keep lending, provided they're good quality loans. So we've seen the banks tighten up a little bit, but still really willing to lend. Certainly in the residential and consumer space, perhaps they've been a little more cautious in the business space at this point.
So that brings up a good point, sort of around the difference between a finance company and or a bank and the way that a peer-to-peer platform works. So we obviously all have to manage credit risk, and credit risk sort of it can be modeled as a risk, and we've demonstrated that earlier on, and it really depends on what you're investing in as to what risk level you've got there. But you were touching on this liquidity risk and the fact that finance companies have liquidity risk, a difference between the high risk lending that they're doing that's largely illiquid and short-term debentures with low risk investors who didn't really know what they were investing in, but they want their money back, and so you end up with this real mismatch that creates problems. The benefit with a peer-to-peer platform is this match funding. So as an investor, you're in the loan. If the loan repays, you get your money back. If the loan stays outstanding, then your investment's outstanding unless you can sell it on the secondary market. The point being that the platform's not taking the liquidity risk. The liquidity risk sits with the investor, which means if we don't have liquidity risk, it makes the platform a lot more stable. And so we can't run into the risk that finance companies have, where they literally run out of money. Another question there, I'll fire this one to you, Dave. Do we get any information on who or where the loan is given to?
Sure. So on the home loan and business property loan investment classes, we're putting out case studies on each loan as it goes onto our platform. You can find those case studies on our website. If you go to the blog section and then financial advice, you'll actually find those case studies there. And what we're aiming to do is to build confidence with our product and show exactly what it is that we're lending on. So I'll give you an example. In the business property loan space or investment class at the moment, the loan that we have up is a person who is adding a floor to a property that's located in St Heliers in Auckland. Once they've added that floor, they're going to separate the title on that property. The LVR on that loan is 10%, so that would suggest that the property is worth about $4 million, and the total amount of borrowing that we've got is about $400,000. So a heck of a lot of equity and a pretty secure income situation with that loan. So that gives you a flavour for one of the loans that's up there today. And as I said, we're writing case studies, which you can find. All our investors get emailed what those case studies are, and you can find them on our website.
So there's a different angle on that, which is, so if you're not an investor in the platform already, when you invest into the platform, it's very, very simple. Our job is to get your money away as fast as possible with as little amount as fast as possible. So when you come into the platform, you just place an order. You choose the asset class that you want to invest in and how much money you want to invest. It's obviously going to be available in your call account. And then it invests it. If there's loans available immediately, it invests it immediately. If there aren't loans available, it will wait until some loans come through, and then it will fill those up. So it can be a relatively quick investment process. And a very simple process. And the reason that we do it that way is that we don't want you to have to credit assess every individual loan that you're investing in. We have a comprehensive credit policy. You've got socialized credit risk, so you're not actually taking the underlying credit risk yourself anyway, because the risk sits over the whole portfolio. So what's more interesting is, what does our credit risk policy look like? And in our handbook, you'll see all of the basic parameters in terms of how we're deciding what we'll lend to and what we won't lend to. And you'll see our team and experience and expertise in terms of assessing risk. But that's something that we're effectively managing on your behalf. It just makes for a very easy investment process. As Dave said earlier, maximum 80% LVR on a residential house. The reality is our target LVR is a lot lower than that. We're sort of targeting an average on the portfolio of between 50 and 60%. With the business property loan, we'll go up to 70% LVR on that, or up to 80% if it's a turnkey with an end buyer having paid an unconditional deposit. So those are the basic risk parameters, and then there's a whole lot more detail there. I'm toying with the idea of actually publishing our full credit policy. It's quite a comprehensive document that's been checked and signed off by one of the banks. My reluctance to do that is it's probably a competitive policy, and I don't necessarily think it would be good if our competitors had a full copy of our policy. There's another question here. I'm not sure. I'm trying to figure the question out. Both residential and business.
I wonder if it's geographic location on that
maybe
one.
Geographic location, yeah.
Yeah, so the bulk of the lending that we'll do will be in metro locations. So that's where, you've got a population base of over 100,000 people, and it will be spread through New Zealand. We don't want to become too centric just in Auckland, for example, or just in Wellington or in Tauranga. So we'll see loans from main metro locations primarily, and we've allowed a little bit of scope and room to do some stuff in the provinces, however that's small. And you can actually see that defined in the investor handbook as well. Yeah. On the limits that we've got in place for those loans. Yeah.
So again, that handbook's a good document to go to for the detail. You'll see, as Dave said, limits in terms of, we've got portfolio limits across a whole lot of criteria: self-employed, credit impairment, geographic location. There's a whole lot of limits, self-imposed limits, that we've put on the portfolio to ensure that we diversify risk and manage that credit risk really, really well.
Hey JB, there's a question here from Alison in the chat section. I'll pick up. So what's the average loss incurred when selling in the secondary market? So it's 1% to a maximum of $50, which I think is, if you compare it to bank policies, I think it's in pretty good shape. So yeah, 1% up to a maximum of $50.
Cool, thanks Dave. Here's a question for you. How can I know whether my return is paid by the borrower or the reserve fund?
Right. So as an investor, you probably won't know because the return simply arrives. Where that starts to become more obvious is if the reserve fund was to be fully depleted. So in that situation, then there is no way to provide that return. Sometime before that, though, I would suggest that Squirrel would be talking to investors and saying, hey, it looks like a reserve fund will become depleted, and we would start taking action at that point, well ahead of that reserve fund getting to a zero balance. But at this point in time, from what we can see of the performance of the reserve fund and the way that we've set this platform up, that's less likely to happen.
So let's be clear in terms of what that action would be. So when we say action on the reserve fund, so we forecast reserves, and because loans go into arrears well before they default, we get a pretty good sense for whether we've got sufficient money in that reserve fund to cover all future expected credit losses. So in the event that we start to get concerned that we think the reserves will run out, we can haircut the interest on the whole pool of investors to push more of the return into the reserve fund to ensure that we've got enough reserves. We're likely to do that before the reserve fund runs out, as Dave was saying. We don't have we'd have to assess it at the time. Our view is probably to do a big hit on the interest component, not principal, but on the interest component for a short period of time, rather than a small haircut over a long period of time.
Pick up the next one.
Yeah, go for it.
This question's from Romeo. Are you getting more investors now that Harmoney has stopped being a peer-to-peer company? Well, the simple answer to that is yes. So we've seen an increase in the number of investors that have arrived into Squirrel since mid-February. I've spoken to, I don't know, 5 or maybe 8 of those investors, and their experience so far has been that they've enjoyed using the platform. They think it's more intuitive than what they were using at Harmoney. I'm not making that up, I promise. That's what they've told me. The behaviour that we're seeing from those investors is typically, as they're repaid money from Harmoney, they're then depositing that into the Squirrel peer-to-peer platform and then investing those funds. So they're kind of taking the run off of their Harmoney portfolio and moving it over to Squirrel. That's the experience that we've seen of the investors that I've been following who have moved directly following Harmoney's lockdown.
One of the points that I'll talk to is historically on our platform, and it would be true of the other peer-to-peer platforms as well, is that it's been quite hard to invest because consumer finance borrowing is expensive to acquire, especially for a digital platform. So it was very difficult to cost effectively get enough borrowers coming through the platform to satisfy investor demand. And that's still true today with our personal loan product. We'll often have more investor money going in and ordering personal loans than the loans available. And so it can take a little bit of time to get invested. The benefit with the mortgage products is that we've got pretty big distribution capability already. So, we write over $1 billion in mortgages a year. So there's no shortage of mortgage investments available on the platform. We've got probably close to 10 million of loans that we've settled with a warehouse facility that we've got that are ready to pass down to retail investors. So although you only ever see, I think at the moment, if you went on, it'll say that there's a 400K loan available, or it might be 300,000 available. There's actually probably close to 10 million available. We're just passing the loans down one at a time. So the good news is we've certainly got the capacity now in terms of loans to satisfy investor demand. We've got way more loans than you can put money into the platform. I'll just answer that next question from Gary, which is it one person per loan or shared with others? It's a peer-to-peer platform, so it is shared with others. So we have got, for example, in the home loan space at the moment, we've got a $1.4 million loan on the platform at the moment. It's secured over 2 properties in Point Chev. It's a 70% LVR. The borrower's got a net asset position of $30 million and surplus cash flow in excess of $1 million a year. So it's a very strong borrower. The reason they wanted to use the platform is to avoid just over-engineered banking, because they end up in commercial bank instead of the normal part of the bank, and he just doesn't like that experience. It gets too hard. So so we advanced him the money as working capital for another commercial property transaction that he wants to do. So look, again, it's just another example of a loan on the platform, but that loan will have hundreds of investors in it, hundreds of little investors putting in bits of investment. It's not a one-to-one relationship, so you don't have to take a whole loan. You can bid whatever you want into the platform, minimum bid $500. Cool. Oh, there's another one. Dave, do you want to take that last one?
Okay. Oh, I hadn't scrolled. Let me have a look.
Yeah, keep coming in.
For a small money investor reaching retirement age, what's your advice for investment, long or short term? Oh, there's a tricky one. So I think, first of all, I'd encourage you, if you've got a lot of uncertainty about your approach to investment, then seek advice. That's probably my absolute first comment. If you want to learn about the platform, you could start with a small amount. So as JB said, the units of $500. If you think about that as a starting point, then you could go and put $500 or a few $1,000s or $5,000, whatever you're comfortable with, and go and experience the platform. And then at that point, as you become more comfortable, you can think about how you might change that amount, either up or down. If you become uncomfortable, well, you can trade it out on the secondary market. If you become more comfortable, then you can place more funds. I think, is it long term or short term? I think probably one of the things you would want to be thinking about, remembering this isn't advice, is how important is protecting that capital to you. So if protecting the capital that you put in is really, really important, then I'd be down at the lower end of the risk spectrum. And that would be general advice that I think any investment advisor would talk to you about.
Yeah, Dave, I'd just add to that that there's a range of products there as well. So you don't just need to think about one singular product. We're going to evolve the platform over time to give investors the ability to construct portfolios of fixed interest product. I'm committing Dave to it now. It's a wee way off, but it's certainly a desire, because the way I like to think about it is that no single product's going to give you the right answer. It can be a mixture of both. The home loan product, as Dave said, is our lowest risk product, and I think it's got a very healthy return, given its underlying risk is very low. It's got a good return at 4%. The business product's a bit more risky. It's short term, more of a working capital product, and that the cash flow is going to circulate a lot more. So you could do a combination. You could do a combination of both. In terms of home loans being a lower risk product with a longer investment horizon, with a bit of business property loans to lift the yield up a bit, but also give more working cash flow because it's a much shorter term product, and so it turns over a lot faster. Through to even potentially some of our personal loan products, if you want to get another little bit of yield uplift there as well, because those loans are sitting at 7 to 7.5%, albeit they can be a bit slower to get invested into. So I think a bit of a mix is always a good way to go.
I think one of the great things about the peer-to-peer portfolio and the different classes of investment that you have available is that you can be quite discreet about the type of risk that you're taking. If I look at, for example, a finance company, then a finance company could be investing in a whole wide range of different types of lending, from consumer finance through to mortgage-backed finance in some way, shape or form. And it's effectively all in the one pot in some way, shape or form. So you're making that investment on the assumption that the finance company's done well at diversifying and managing the risks of that. With Squirrel's peer-to-peer portfolio, each of these investment classes has got its own discrete risk profile. So you can think about the risk that you want to take.
Yeah, I don't know if we covered that off, Dave, but it's probably worth it. Is that when we talk about an asset class, so home loans, business property loans, personal loans, each of those asset classes has its own reserve fund, with its own socialization clause. So we, as Dave was saying, we don't taint different assets across different classes. If you're investing in home loans, your risk exposure is only to home loans, and there's a home loan reserve fund. So we keep them in separate silos, which, as Dave said, means that you are genuinely investing into the asset class that you want to invest in. Looks like that's pretty much all our questions. Is there anything else that you wanted to cover off, Dave?
Probably, assuming there's no more questions, then really feedback. So for anyone who's on the call today, I think we've had 30 or so participants on the call today. If you have feedback on what we've talked with you about today, good, bad, or ugly, you think there's ways we can improve, don't be afraid to tell us, and I'll give you my email address in a moment. And if you have questions that you didn't want to ask today but still remain unanswered, feel free to send them through to me. So you can email me at dave@squirrel.co.nz. So I'll say that one more time. It's dave@squirrel.co.nz. And I'll be great to have some feedback. And if you have any other further questions, feel free to ask them. I know after the webinars we ran last week, I had 2 or 3 different questions come through afterwards. So don't be afraid.
Awesome. Well, hey, thanks guys for coming along today. We really appreciate it. We really appreciate that you're interested in investing in a peer-to-peer platform, and I guess supporting what is a reasonably new and innovative way of connecting borrowers and lenders or investors. That's great for everyone. Investors get higher returns and borrowers get better loans. Hopefully you found it really interesting. If you're already an investor in the platform, thank you. We really appreciate it. And to those of you that are just getting started, it'll be great to have you on board. So thanks from me and Dave.
Thanks, everyone.
Okay, cheers.